How did two Singaporeans retire with millions? One at 37 with 3 kids, and another at 47 with $3 million. Today, I want to share these two powerful case studies with you. Stay till the end, because I'll also explain why being cash flow rich through dividend investing could be a safer, more sustainable way for many Singaporeans to achieve financial freedom. And if you find this video useful, do give it a like so more Singaporeans can watch it, and subscribe to Wealth for You for more real stories and strategies. Now, before we dive in, let me be clear. These case studies are not here to criticize anyone. They are here to highlight learning points for all of us. At Wealth for You, we want to congratulate both individuals on their amazing achievements in early retirement and share what Singaporeans can learn to plan their own future better. These case studies were found on YouTube. If you're curious, you can search for them and watch their full stories directly. Disclaimer: the content here is for education and sharing purposes only. This is not financial advice. Each journey is unique, investments carry risks, and you should always do your own research or consult a licensed financial advisor before making decisions. Chapter 1. Retirement Trends in Singapore. Before we dive into the case studies, let's first take a step back and look at the bigger picture of retirement in Singapore. Now, while there isn't official government data on exactly how many Singaporeans retire before 60, surveys do give us some important insights. Many younger Singaporeans, especially millennials and Gen Z, aspire to retire early, sometimes well before 60. But the reality is much tougher. The high cost of living, family responsibilities, and often not having enough savings make early retirement a challenge for most people. In fact, a 2024 survey found that those who have already retired left the workforce at an average age of 59. But for those still working, the expectation is to retire later, around 64. Rising life expectancy and policy changes are part of the reason. By 2030, Singapore's official retirement age will rise to 65, and the re-employment age to 70, reflecting the government's push for older workers to stay active longer, both financially and socially. At the same time, the FIRE movement, financial independence, retire early, is gaining traction here. More young Singaporeans are saving aggressively and investing with the goal of breaking free much earlier than the traditional retirement age. And that's why today's two case studies are so powerful. They give us a glimpse of what's possible and what we can learn if we want to shape our own retirement journey. So in short, the desire for early retirement is strong, but the actual number who achieve it before 60 is still a minority. That's why stories like today's two case studies are so interesting. They show us what's possible with discipline, planning, and sometimes a bit of luck. Chapter 2. First case study. Retiring at 47 with $3 million. Our first story is about JP, a working mom from Singapore who spent over 2 decades in the corporate world. Like many of us, she was focused on her career, juggling work and family life. But earlier this year, she was laid off. For many, that would have been a frightening moment. But for JP, it turned out to be a turning point. When she sat down to review her finances, she realized something incredible. She had already achieved financial independence. Her net worth had crossed $3 million, a mix of stocks, funds, CPF savings, SRS, and insurance cash value. Even her humble HDB flat was now valued at over $1 million. Suddenly, the idea of retiring early wasn't just a dream, it was her reality. Instead of rushing back into another job, she made the bold decision to retire at 47 and live life on her own terms. But she wasn't reckless about it. She carefully mapped out her financial strategy. She decided to stick with a 3% safe withdrawal rate instead of the more commonly used 4%, giving her more confidence that her portfolio would last through a long retirement. She built a cash buffer of 2 years' worth of expenses. This way, she wouldn't be forced to sell stocks when markets turned down. something that can devastate early retirees. And she adopted what she calls a total return approach. That means she isn't relying only on dividends. Her retirement income comes from a mix of dividends, interest, bond coupons, capital gains when she sells some investments, and even option trading income. It's a thoughtful and diversified plan. And while she could have gone all in on high dividend stocks and REITs to generate a big monthly paycheck, she chose balance, knowing that dividends can be cut during bad years and growth is still important for a retirement that could last 40 years or more. The key learning points from JP's journey are clear. Be conservative in your planning, always keep a safety buffer, and remain flexible in your spending. These principles can make early retirement much more sustainable. Chapter 3, Second Case Study. Retiring at 37 with $2.5 million and 3 kids. Our second story is even more striking. Imagine retiring at just 37 years old, and not just as a single person, but with a spouse and 3 young children. That's exactly what this Singaporean couple managed to do. Together, they built a net worth of about $2.5 million. How did they do it? It wasn't inheritance, and it wasn't luck alone. It came from years of extreme discipline. At the peak of their careers, they were pulling in a combined salary of around $6,000 to $7,000 each month. Not sky-high compared to today's tech pay packages, but what made the difference was their savings rate. At one point, they were saving an astonishing 70 to 80% of their income when both of them were working. Even when the wife took a break to stay home with the kids, they still saved around 50%. They started with local stocks, but later shifted to U.S. growth stocks and crypto. Higher risk, but also higher potential returns. Over time, their investments grew substantially, with about $1.9 million coming from capital appreciation alone. And they lived incredibly frugally. No car, no luxury watches or branded bags. They stayed in their HDB flat and hunted for deals on almost everything. Their kids attended government childcare and only recently started modest enrichment classes like Chinese and swimming. When the husband's job at a Chinese tech firm became toxic, long hours, pay cuts, office politics, and even working on public holidays, he realized it was time to walk away. With $2.5 million already built up, they had crossed the threshold for financial independence. The 4% rule suggested they only needed about $1.5 million to cover their annual family expenses of $60,000. Having $2.5 million gave them a solid buffer. So at 37, he quit. Instead of chasing promotions, he chose to spend time with his children, manage the family portfolio full-time, and focus on health and well-being. Their lifestyle is simple but deliberate. They splurge on experiences, travel, indoor playgrounds, family outings, but continue to avoid unnecessary luxury purchases. They want their kids to learn the value of money through everyday frugal habits rather than being handed everything on a silver platter. The lessons from this case study are powerful teamwork in marriage, an ultra-high savings rate, and the courage to reject social pressure can accelerate financial independence dramatically. But at the same time, their reliance on risky growth assets and very little cash buffer means they are taking on more volatility than the average Singaporean might be comfortable with. Chapter 4. Critical Evaluation. Now that we've walked through both stories, let's take a moment to evaluate their approaches. For JP, who retired at 47, her plan has many strong elements. She chose a conservative 3% withdrawal rate, which gives her more peace of mind compared to the usual 4%. She also set aside a cash buffer of 2 years, protecting herself from having to sell investments during downturns. And she uses a total return approach, drawing income from dividends, interest, capital gains, and even some option trading. This creates multiple income streams instead of depending on just one. That said, her portfolio is still heavily weighted toward equities, more than 80%, which can be risky in long bear markets. She also leans on option trading for extra income, which requires skill and discipline and doesn't work for everyone. A slightly higher allocation to defensive bonds or safer income-generating assets could make her strategy more resilient. Now, for our 37-year-old retiree, the achievements are equally impressive. To save and invest so aggressively while raising 3 children is no small feat. Their savings discipline and frugal lifestyle allowed them to reach financial independence far earlier than most people could dream of. On top of that, they stayed true to their values, resisting social pressures to buy cars, condos, or luxury goods. The trade-off, however, is that they are heavily exposed to growth stocks and crypto, which can swing wildly in value. Their target of 15% annual returns is ambitious, and while it may pay off, it does carry more risk than a traditional income-focused approach. With only a small cash buffer, they will need to be comfortable riding through volatility without panicking. Both journeys are inspiring, and both show us that there isn't just one path to financial independence. But what they remind us is that retirement isn't only about reaching a certain number in your portfolio. It's also about building sustainable cash flow, stability, and peace of mind that can last you through decades of life ahead. Chapter 5. Why dividend investing works better for many Singaporeans. Now that we've looked at these two inspiring stories, let's talk about an approach that is often closer to the hearts of Singapore investors. Dividend investing. Both JP and our 37-year-old young retiree relied heavily on the idea of a withdrawal rate, whether 3% or 4%. This method is based on drawing down a percentage of your portfolio each year, adjusting for inflation. It works well in theory and has a lot of academic research behind it. But here's the challenge. The method was built largely on U.S. market data, where the economy has grown strongly for decades. In Singapore, and even in global markets, results can be more volatile. If you retire early and markets crash in your first few years, your withdrawal strategy may come under stress. You might be forced to sell assets at a loss, and that can permanently shrink your retirement pot. That's where dividend investing shines. Instead of depending on selling shares to fund your lifestyle, you build a portfolio of companies and REITs that pay you cash flow regularly. Think about our 3 local banks, DBS, OCBC, UOB, or stable REITs like Ascendus or CICT. These companies share their profits with you every quarter, and the beauty is that in Singapore, dividends are tax-free. Every dollar you receive goes directly into your pocket. And here's the magic of the compounding effect. When you reinvest those dividends, you buy more shares, which in turn pay you even more dividends next time. Over 10, 20, 30 years, this snowball gets bigger and bigger. Many Singaporeans who started modestly in REITs or blue-chip stocks are now enjoying 5-figure annual passive incomes simply because they stayed consistent and reinvested along the way. Another advantage is that dividend investing pairs well with dollar-cost averaging. You don't need to time the market. By investing regularly, month after month, you smooth out the ups and downs of stock prices. Over time, your cost averages out, and your dividend income grows steadily. Now, of course, dividend investing isn't perfect either. Dividends can be cut during tough years, as we saw in the pandemic. But compared to the anxiety of selling shares during a downturn, many investors find comfort in knowing that even in weaker markets, solid companies often continue paying some level of dividends. That steady stream helps you sleep better at night. So why is this approach especially meaningful for Singaporeans? Because it's not just about being paper rich with a big net worth. It's about being cash flow rich. When your passive income from dividends can comfortably cover your lifestyle expenses, you don't need to worry as much about market crashes or inflation. You can live with confidence, knowing that your portfolio is working for you every single day. That's why many income investors here see dividend investing as a more practical and sustainable way forward, one that fits our local market, our tax system, and our desire for peace of mind. Final thoughts. So here's the big takeaway. Retiring early is possible, as we've seen from these two inspiring case studies. But for many Singaporeans, focusing on dividend investing and building steady cash flow may be the safer, more sustainable, and less stressful path to financial freedom. If you found this video useful, do give it a like so more Singaporeans can watch it, and subscribe to Wealth for You for more practical lessons and real stories that matter to us here at home. And I'd love to hear from you in the comments. Would you prefer to chase early FIRE, or would you rather patiently build a dividend portfolio that pays you for life?